For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. SoFI Technologies ended the year with an impressive performance, posting an annual stock price increase of nearly 55%. This achievement is particularly notable, given that earlier in the year, the stock experienced a prolonged period of negative trading during the first 9 months. Despite this challenging start, SoFi demonstrated its resilience by building momentum and proving its ability to grow profitably. Over the course of the year, the company succeeded in adding millions of new members, expanding its non-lending services, and improving its financial position. Its mobile application offers a wide range of services, including access to bank accounts, credit cards, loans, and investment tools, making it a one-stop destination for financial management. While SoFi initially gained prominence for its lending services, especially student loans, the company has evolved significantly. Its leadership has implemented a strategic approach referred to as the Financial Services Productivity Loop. This strategy focuses on acquiring customers through a single service offering and then encouraging them to adopt additional, often more profitable services. The goal is to create a cycle of engagement that drives both customer satisfaction and revenue growth. Beyond its core lending segment, SoFi operates 2 additional divisions: the financial services segment and a technology platform known as Galileo. Galileo, which was acquired in 2020, provides financial infrastructure services and is positioned as a major growth driver for the company. Management has articulated a bold vision for Galileo, aiming to transform it into the equivalent of Amazon Web Services for the financial services industry. This ambition underscores SoFi's commitment to diversifying its revenue streams and becoming a leader in the financial technology space. The results of this multifaceted strategy are becoming increasingly evident. SoFi's non-lending segments have been growing at a faster pace than its traditional lending operations, leading to a greater contribution to the company's overall revenue. Total revenue for the quarter increased by 30% year over year, and the company welcomed 756,000 new members during this period. Additionally, revenue per product increased significantly, rising from $53 in the prior year to $81 this year. In the third quarter of 2023, SoFi recorded its first ever quarterly net profit, primarily driven by its lending business. By the same quarter of the following year, all business segments had demonstrated year-over-year growth, with the financial services division showing particularly strong profitability gains. This indicates that the company's strategy of diversifying its revenue streams is paying off. The lending segment, however, continues to play a pivotal role in SoFi's overall performance. The market remains highly focused on this segment, as it accounts for the majority of the company's gross profits. Encouragingly, recent developments in the lending business have been positive. With benchmark interest rates declining, the lending division is showing signs of improvement. Management has expressed optimism about the potential for increased lending revenue for the full year. This progress has alleviated some of the market's concerns about the lending segment and reinforced confidence in the company's long-term growth prospects. SoFi is scheduled to release its fourth quarter earnings for 2024 on January 27th. Historically, the company's management has adopted a conservative approach to setting expectations, often under-promising and subsequently exceeding those expectations. If this trend continues, the upcoming earnings report could serve as a catalyst for further stock price gains. Investors will likely be closely monitoring key metrics such as member growth, revenue per product, and profitability across all segments to assess the company's progress. It is worth noting that SoFi's stock has exhibited a pattern of reacting strongly to positive news, often rising sharply following earnings announcements or other favorable developments. However, the stock has also demonstrated a tendency to retrace some of these gains in subsequent trading sessions. Rather than focusing on short-term fluctuations, investors should consider the company's substantial growth potential and its ability to execute its strategic vision over time. Over the past year, SoFi has consistently delivered strong results across a range of key performance indicators. These include robust member additions, significant revenue growth, and notable improvements in profitability. However, a deeper examination of the lending segment reveals a more nuanced picture. The segment's financial performance is influenced by a variety of factors, including loan originations, default rates, loan sales, and income generated from lending activities. Despite these complexities, SoFi's recent third-quarter results provided reassurance to the market, leading to a sustained increase in the stock price. Since the Federal Reserve began lowering benchmark interest rates in September, SoFi's stock has experienced significant upward momentum. With the next quarterly earnings report approaching, the recent dip in the stock price could present an attractive entry point for investors. In other news, Palantir Technologies has been growing rapidly. This dramatic growth was driven by the company's positioning as a leader in artificial intelligence software, a sector that gained massive attention and investment throughout the year. However, according to analysts at Jefferies, this extraordinary climb in valuation appears to be stabilizing. The firm's recent analysis indicates that Palantir's valuation is returning to more realistic levels after what can only be described as a stratospheric journey. Jefferies analysts observed that Palantir's enterprise value, which reflects the total value of the company, including both its equity and debt, has declined to 46 times its anticipated revenue over the next 12 months. This represents a significant drop from a prior multiple of 55 times revenue. The adjustment follows the company's valuation skyrocketing by nearly 300% in 2024. While these gains reflect substantial investor enthusiasm, Jefferies analysts, led by Brent Thill, have maintained a cautious stance on the stock. They have rated Palantir at underperform, suggesting that the stock may face challenges ahead. Additionally, the analysts set a price target of $28 per share, indicating their belief that the current valuation may still be inflated given the company's underlying financial metrics. This isn't the first time the stock market has witnessed such lofty valuation multiples. Jefferies highlighted that similar trends occurred during the height of the COVID-19 bubble. At that time, several high-growth technology companies, including Snowflake, CrowdStrike Holdings, and Datadog, experienced sharp increases in their valuation multiples. These increases were largely driven by investor enthusiasm for rapidly expanding sectors and the influx of liquidity into the market during the pandemic. However, as conditions normalized in subsequent years, these multiples compressed significantly, bringing valuations closer to sustainable levels. Jefferies analysts believe that the current market environment is far more stable compared to the speculative frenzy of the COVID-19 era. They emphasized that macroeconomic conditions have normalized, with factors such as interest rates, inflation, and monetary policy now playing a more prominent role in shaping investor sentiment. According to their analysis, any negative developments such as rising interest rates, a decrease in enthusiasm for artificial intelligence technologies, or increased insider stock sales could exert downward pressure on Palantir's valuation. These factors make it crucial for investors to carefully evaluate the risks associated with the stock, particularly in light of its elevated multiples. Despite the cautious outlook, Palantir's stock saw a notable rebound in recent trading. On Tuesday morning, the company's shares rose by over 3.9%, reaching $67.48. This uptick put the stock on track to break a 5-day losing streak. However, this gain comes against a backdrop of a challenging year for the stock, which has declined by 11% since the beginning of the year. This follows an extraordinary performance in 2024, during which Palantir's stock value increased by over 300%. According to data from Dow Jones Market Data, the recent rally provides a glimmer of hope for investors looking to regain confidence in the stock. The sentiment among analysts remains divided. Data from FactSet reveals that only 14% of analysts currently rate Palantir as a buy. A majority of 50% have adopted a neutral stance, indicating that they neither expect significant upside nor downside in the stock's performance. Meanwhile, 36% of analysts recommend selling the stock, reflecting concerns about its high valuation and the potential for downside risk. This divergence in opinion underscores the complexity of evaluating Palantir's stock, particularly given its position as a leader in artificial intelligence, a sector that is both highly promising and subject to intense scrutiny. In conclusion, Palantir Technologies has undoubtedly captured the market's attention with its phenomenal growth in 2024. However, as the company transitions into a more normalized valuation environment, investors must weigh the potential opportunities against the risks. Factors such as macroeconomic conditions, insider activity, and shifting market sentiment could influence its trajectory. As always, staying informed and maintaining a balanced perspective will be key for anyone considering an investment in Palantir. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.